Hello everyone, and thank you for watching this video. Today is October 30th, 2023, and I will provide an update on the stock and bond markets for this year. My name is AJ Kratofil. I'm the managing member of Vital Wealth Management. There's a lot to discuss, so let's jump in. Topics for today include the US economic growth, which we call GDP, inflation, bonds in the Fed policy, and the US stock market. So let's look at some of the long-term trends of economic growth in this country. This graph right here is the US GDP, and what you'll see in the gray line is the real economic growth, and the blue dotted line is the trend growth line over the long haul. So what you'll see is from 2001 up until last quarter, you can see that the US economy has been growing pretty consistently, short of the COVID, shutdowns. We've gotten back to kind of that 2% economic growth. Year over year, we're just over 2.9% here, and for the third quarter, 4.9%. So that number just came in at the end of last week, and it was a pretty darn good economic growth number for a quarter. Seeing that we kind of trend 2% over the long haul. So there is no sign of a recession at this point. There's always the worry, right, that you could fall off moving forward. But at the end of the day, the economy has stayed quite strong and resilient of all these Fed rate hikes. And most economists calling for this year to be a recession. There's not really been a recession at all. The Atlanta Fed comes out with Q4 GDP forecast, and just with a little bit of data that has come in already through the end of last week, they're predicting 2.3% growth in the fourth quarter. We'll see where it lands. There's still a lot of economic data to come out, but it should be a cooler number than the third quarter, but also in positive territory. This is the Cleveland Fed statistic. So what we like to look at here is what's the probability of a recession based on the yield curve. And that's just a fancy way for saying, what's the 10-year treasury? What's the 10-year loan rate that the US government is receiving in the open market minus the 3-month treasury rate? Now, the Fed controls that 3-month treasury rate, but they really don't control the 10-year. That has a lot more of the dynamics of the economic growth, inflation, and there's several buyers and sellers out that far on the curve. So it's a pretty good indicator. And the chance of recession is currently at 67% in September, which is down from 78% in June. So, the odds of a recession are starting to go down actually at this point. The chance of a recession was too low, in my opinion, back in March of 2022, when we were in the middle of 2 quarters of economic detraction at the beginning of 2022. We saw only 4.9% chance of an economic downturn. I think largely this is because the Fed has been behind the curve in hiking rates. So with the Fed behind the curve in fighting inflation and hiking rates, 3% from March to September, this predictive tool was behind the curve as well. So basically, what I'm trying to say here is that the curve that has predicted the future probabilities of a recession seems to have been behind the curve in predicting an economic downturn this time because the Fed was so far behind the curve in raising interest rates. But we still shall see. So where does inflation land off the highs here? Back in June of 2022, we saw the high in inflation here. And the blue line here is the history going back to the 70s of CPI inflation. This is if you eat and drive. This is called headline CPI. And you can see it peaked out here at 9% back in June. And since it's come down a great deal, it bounced off the lows. I mean, it wasn't going to go straight down forever, but you get the idea that things are starting to normalize. As of September, we're at 3.7% inflation rate. And, while that's higher than what the Fed wants at a 2% mark, it's going to take some time to get down there based on all the stimulus and all the activity in the economy. So the long story short here is that inflation's getting better. It's still kind of on the high point of that, close to that 50-year average, going back to the 70s. But long story short is it is improving and should continue to improve. I do like to look at the month over month numbers because this gives you a good idea of what's kind of falling off, where the numbers might go into the future. And this helped us predict that inflation was going to fall dramatically this year. Um, and we knew we were going to get a bit of a base rate increase here in the last couple of months because we had some really low numbers falling off. But when we take a look at, this is the 12 months of inflation that we've seen. And again, this is using the headline CPI if you eat and drive, because most of us do. So the 6-month average is 3.8%. Again, the Fed wants to get this to 2. The current rate is 3.7. And shelter index has really been the driver keeping this higher than normal. So shelter index contributed to over half of September's inflation. And so September's inflation was 0.4 for the month, 0.6 in August. So you can see the last 2 months we've kind of jumped up a little bit higher on this graph, but we are going to lose almost 1% here in September, 0.4, and October, 0.5. So we do have some seasonality and things that are going to help us reduce inflation here in the next couple of months. I do like to look at this because most of us own a home in the United States, and just kind of taking a look at the craziness in the housing market, it's really been abnormal to see the housing market quite this strong in the face of all these Fed rate hikes. And while it's very expensive to go get a mortgage at this point, there's just not a lot of supply, and a lot of current homeowners are locked into these very, very low interest rates. So what you'll see here, and why I think the Fed has some flaws, I think, in their CPI research, is that shelter has been going up for about 41 consecutive months based on the way the Fed calculates it. But as you can see here, this is just the median home price in America over the last 12 months. So while we're back to where we were 12 months ago, there really has been declines in the overall housing market, or weakness in the overall housing market through that last 12 months. And the Fed didn't pick up on any of that. So I am a bit concerned that hopefully the Fed's not fighting the last battle so much that they're forgetting about the next 12 to 18 months and what is likely to cool off in those markets. People haven't talked about this as much, but this is the New York Global Supply Chain Pressure Index. So I like to remind people that it wasn't that long ago, Christmas of 2021, that there were all those ships in the Long Beach ports looking for ability to get in and deliver Christmas gifts. And here we are now at really low supply chain issues. So the supply chain has eased, and that's helped reduce inflation from that 9% down to the 3.7 that we're at today. And that looks to continue to ease, or at least not work against us moving forward to kind of combat inflation. So are we close to the end of the rate hike cycle? Well, it's tough to say, but as you can see, the Fed right now is between 5.25% to 5.5% from a Fed funds rate standpoint. So what that means is that banks can go and get loans overnight at these very high rates of 5%. That's also good for savers. So for the first time ever in a quality savings rate, you might be able to get 4 to 5% now, 5% plus on CDs going out 3, 6, 9, and even 12 months. So that's great for savers to make a little bit of money on their money. And you can see the impact in the quickness. This is the largest Fed rate increase in my lifetime. I'm 44 years old, and the Fed has never raised rates this quickly before in my lifetime. So you get an idea that this is where rates are currently. But what I really like about this graph is the purple diamond over here shows that what the Fed's projections are for the long term is to be at 2.5. Now the Fed can get a lot of things wrong, but at least take a look here at what their thoughts are. The blue diamonds here are the FOMC year-end estimates. So they think by year end, you're going to start to see a cooling as you follow these dots down in the next several years, a reduction in short-term interest rates. I think that's a good thing. And it's something that I want to remind clients that, while you own some of these bonds for the long haul, you're going to want to lock in or do something called extending duration, which is to lock in these high rates today for the future, because they're maybe not going to be here as long as we project. So these are the change in interest rates since December of 2021. And I think it's important to show that because that's probably the last of the low rates from the COVID era. and you'll see if you loan money to the US government, it was 1.5% or so interest that you received. If you loan money on a 3-month basis, there was literally no interest on that bond. And as of October 20th of 2023, you can see that we're up into the mid fives of an interest rate policy. And if you go out to the 10-year, it's around 4.9. I mean, hovering close to 5% now to lock money in for 10 years. So, there's been a lot of damage in the bond market over the last 2 to 3 years, some of the worst performance we've seen. But again, I think that also creates some opportunity moving forward. These high rates guarantee that future bond investments will be at higher interest rates. And if there's any reduction in rates, you should get an increase in price instead of the decrease in price that you've been receiving the last couple of years. One other thing to look at, I think BlackRock does a really good job here. They like the idea of adding duration to the fixed income. And if you take a look here at number 2, the 3 reasons to look beyond cash, what I really wanted to focus on was number 2, which is cash underperforms following a Fed pause. Many believe that the Fed could be, maybe has one more rate hike left potentially this year, early next year, but most likely they're close to pausing. Pausing just means no more rate increases, and usually after the pause, you tend to get a reduction in rates at some point. And so the average 12-month performance following the last Fed rate hike, and this is from 5 different rate cycles from the 1990s, 1994 through this year, you can see that cash does typically 4.5%, nothing wrong with that. But short-term bonds make about 7.5%, and US core bonds that go out more like 5 to 6 years in duration and maturity, they end up doing 11.5. And that's just because the very thing that was hurting the bond market the last several years is that these rates have been going up, and that hurts current price. Well, when rates go down, that helps current price. So now not only can you get your 5% in the bond market, but you might be able to get an extra 6% in price increase once rates do start to drop. And typically the Fed pauses for a while, but there's not a lot of long-term numbers. If we go back a slide here, there's not too many times that you see the Fed pause and go higher again, but anything's possible. So if we take a look at the idea of extending duration, as a financial advisor, I started in the business in 2007, 2006, that kind of time frame, and many clients would tell me, I wish I could go back to the days of the early 80s and the 70s when I could get 15% on safe money. But the challenge here is that most people were so used to rates going up that they didn't lock in rates for a long period of time back in the late 70s and early 80s because rates have been moving up consistently. And so you get the idea here that when rates are high, you actually want to lock them in for as long as humanly possible. Now, predicting the high is always going to be a hard thing, just like predicting the low in the stock market. But you can clearly see here that as of the last month or so, you can see that the interest rates have been going up and up and up. And this is probably the highest level we've seen since about 2006 on this graph. So buying bonds today, or at least extending some of your duration, does make sense to lock in these rates for a longer period of times, because the future probably will have a bit lower rates than we have today for several reasons. So let's talk about some of the reasons that interest rates are rising. What I like to show here on the left, and this is from JP Morgan, is this is the federal budget. So in 2023, the government spends $6.2 trillion a year. And you can see the borrowing, we borrow $1.4 trillion to meet our current needs. And so we are issuing a lot of bonds in today's market at higher rates, and that's not good for the overall net interest payments for the United States. The higher the debt you have at higher interest rates really puts damage or puts pressure, I would say, on the current budget, which Washington can agree on very little these days, let alone a shrinking budget, because the net interest of our debt is going up by the day. But you get the idea that there's new bonds are being issued. So there's a large supply of treasuries with this current budget deficit. So we're overspending to some degree, to the point where we're issuing debt that puts more supply of bonds. More supply can create potentially higher rates. Inflation's a bit higher. We're at the 50-year average roughly right now, at 4%, but that's above the 2% rate that we've kind of been at for the last 10 years. So inflation's a bit higher and stickier. Economic growth is stronger than forecasted. If you recall, I want to say almost 60% of economists going into this year thought we were going to have a recession. Recessions tend to push people to flock into safety, which would be the bond market, especially the U.S. government bond market, which would keep rates low. But since that really hasn't happened, rates are kind of going up because the economy is growing and there is no recession at this point. The Fed is selling its balance sheet as well. So the Fed has bought up a lot of bonds through COVID to support the economy, and now they're selling that back into the market. So on top of the large supply in the first bullet point, you have the Fed selling additional bonds into the bond market on a monthly basis. And major purchasers like Japan and China have reduced their buying as well as they deal with their own issues, whether it be a geopolitical issues with China or Japan just defending their own interest rate policy. They'll have to sell treasuries in the open market to help their own economy. So those are some issues. All in all, I do want to note though that there's been a lot of buyers of these U.S. treasuries as well, and those are purchasers in the United States. So savers are buying these up, and as well as other countries have stepped in. Even though some of the big ones like Japan and China, I think, get the headlines, the net buyers of U.S. treasuries are still foreign investments, are still buying bonds, even though some of the big names like Japan and China have reduced their holdings. So let's talk a little bit about the stock market. It's been a wild, kind of crazy year, just like last year, but historically, Q4 stock returns bounce back when September is negative. So this on the left side is 2023 stock market return by month. So you'll see here that, in January, stocks did really well, up 6%, then dropped 2% in February, then we went up 3%. And you can see that we've had more up months than down months. Year to date, through the end of the quarter, through the end of September, we were up 13% on the S&P 500. But we have seen some weakness here in August and September being negative. But when you have a negative September and a positive year to date, historically, you've had a 3.8% or so fourth quarter return. So I am optimistic that whether it's, we'll talk about some of the seasonality, some of the sentiment, that maybe there's a bit of an upswing here to finish the year for stocks. So I do like to talk about the history of market valuations and interest rates. And you can see here that, as of the end of October, the forward PE ratio is around 17.5 on the S&P 500. So, that gives us an idea of kind of where we've gone. This is the since 1996, you can kind of see these are the forward valuations of markets at key times, whether it was March 24th of 2000, we traded at 25 times forward earnings. In October of 2007, we traded at 15 times earnings before we fell here with the tech bubble, and the market fell here with the it wasn't that the market was too expensive here in 2007. It was more that we were going into the global economy, the housing market downturn, the financial crisis that ensued. But down here, you got 10 times forward earnings in March 9th of 2009. And that kind of kicked off this very long, always issues in between, but long stretch of 400% return from, March 9th, 2009, all the way through February 19th of 2020. And we know that was a time period of COVID. So we got to 19 times forward earnings, and we dropped down to 13 times forward earnings under that 1 month of deterioration of COVID, where we lost about 34% of stocks. And since then, we've skyrocketed up another 100+%, got to 21 times earnings, fell down in October of last year. Last time I did an event like this, the stock market was trading at 15.7 or 16 times forward earnings. Today, we're at 17 times forward earnings, not terribly different, but the market's a bit higher than it was off those lows of October of last year. So again, I'm optimistic that the stock market's not crazy. from a valuation standpoint. And I still think that there's some room to grow here. We'll talk about earnings as well here in a second, but this is the S&P 500 valuation. If we look at the forward PE going back to the mid 1990s, and there's periods of time where it's very expensive, periods of time where it's very cheap. And then what this is saying is that the 25-year average is about 16.7. What this means is that you're paying $16.70 today for $1 of corporate profits in 2024. So all in all, for us to be trading at 17 and a half or thereabouts, and this changes on the day with earnings, but the idea is that if you're trading around 17 times earnings, that's not crazy from a 25-year average valuation. The other thing that I think is important to note is just that, top 10 stocks, the top 10 stocks in the S&P 500 have driven a lot of the growth for the year. They're a very big percentage weight in the S&P 500. So you'll see the PE ratio for the top 10 and the remaining stocks in the S&P 500. So, the current top 10 have a forward PE of 28, versus 17. So you can clearly see that a handful of stocks with their big growth engines, whether it be the NVIDIAs of the world, the Amazons, the Teslas, those tend to kind of come at a very high premium, very high valuation. And they're a big percentage of the S&P, so I don't need to discount that too much. But just to show you that the whole stock market is really not trading at these very high, lofty values. It's probably a handful of companies or a sector or two, but other sectors seem to be more fairly valued or maybe even cheaper than historic averages. Morningstar does a really nice job of just showing what they believe in various style boxes are their fair market value, the fair value of stocks that trade in these boxes. So to be diversified, we believe, and Morningstar believes, that you've got to have large companies, medium-sized companies, and small companies. And then there's value, core, and growth. Core is just a blend of growth and value, but growth stocks tend to be the stocks that don't pay dividends. As they make profits, they reinvest in the business to grow the business. The value names tend to be the names that companies that have already grown their balance sheets and their profitability and are now maybe paying dividends, maybe buying back shares a bit more, and rewarding shareholders for staying with them. They're more mature and stable businesses. And what you'll kind of notice here is that large companies in America that are trading in the value space, Morningstar believes at this point they're trading at 86 cents on the dollar, so that they think there's about a 14% increase for them to get to fair value. Again, that's one company's thought process, but you get the idea that large growth stocks are at 92%. So they think that there's a bit of an increase for large cap stocks in general on the growth and value side, with value stocks being a bit more cheap compared to growth stocks. And one of the most interesting style boxes is down here, this small cap value, which long term, when you look at the numbers back to the 1920s, this small cap value box tends to outperform all of the boxes, all of these different styles and metric on this matrix. But 62% of its fair market value, or 62 cents on the dollar, if the economy holds up here and small cap value stocks hang in there, there could be some nice returns from this style box moving forward. So we want to make sure that clients have exposure to this, even though it's been a rough ride so far. Let's talk a little bit about earnings, because the primary reason you own stocks is that you want your companies to create profits and earnings. So for Q3 2023, analysts were projecting back in September earnings would grow 0.5% for this quarter, and it was really going to be kind of the bottoming out, that we're going to see a little bit of growth in profits from a couple of quarters that were negative. But with 49% of companies reporting as of Friday, we're on track for 2.7% earnings growth for the third quarter. So at this point, things are starting to move in the plus movement there. Even though stocks had a bad week last week, earnings weren't all that bad. For Q4 2023, analysts are projecting earnings growth of 8% for the fourth quarter. And then the S&P is expected to report earnings growth of about 1% for 2023 as a whole. And 2024 is expected to have earnings grow at 12%. So if we do get these numbers and we kind of stay on track here, I do think there could be a nice movement up for stocks from these numbers. Cycles of U.S. outperformance. I think this is interesting. The jury's still out. It's not really been definitive here, but it is important to have international stocks in the portfolio. I know we talk a lot about the U.S. economy, the U.S. stock market. There is a home country bias. Wherever you are, you tend to think your stocks market, your bond market is kind of superior than everybody else's. But when we look at long periods of time, back to the 70s, you can see that in purple, this is when the international stocks outperformed US. They could have both been up, but US or the international in purple would have outperformed during the beginning part of the 70s. And they kind of rotate back and forth. The dark, the shaded gray here is the U.S. outperformance. And then there's a period back here in the 80s where international actually outperformed over a 5-year period, 299%. And we kind of were going back and forth on who was better, outperforming who, until really the financial crisis. And ever since 2008, it's been the U.S. dominance, 14 years, 277% return. And it wasn't until recently that international actually started to outperform. It's not been by much, but it has been a little period of international hanging in there. The valuations are cheap, the dividends are nice. A lot of bad news is kind of priced into the emerging markets as well as developed international. So I do think it's important to have that allocation in the portfolio and stay there and rebalance into that weakness, because there is going to be a period of time, most likely, where the international does outperform, and we want to have exposure to things like that. This is the American Association of Individual Investors. And every Thursday, this is free information you can get online. And every Thursday, they pull 1,000 high net worth investors and ask them what direction in the next 6 months do they think the stock market's going to go. And so you can see if you're bullish, you think the market's going up. If you're neutral, you're not quite sure. And if you're bearish, you think the market's going down. So when we look at some of these historical averages, over the long haul, 37.5% of people tend to think the market's going up. 31% of people think it's neutral. 31% of people think it's going down. So a little bit of an edge to the bulls over the long haul. But when you look at just last week, October 25th, we actually only had 29% of people think that the market's going up. So that's one of the lower numbers we've seen here recently, and it's below the historical average. So this is a contrarian indicator. So whenever a lot of investors are kind of sour or low optimism on the U.S. stock markets, when you tend to get nice, movements up, or have a chance at least to have a nice movement up, and it's because all the people who are down on the market have already sold, and that's reflected in current prices. So you also see that 43% of people, are actually bearish on the overall market. So that's a lot higher than 31%. So right now, I think there is a chance, based on sentiment, that it's getting, the pendulum can swing too far to the negative side, just like it can swing too far to the positive side. I mean, take a look at this. The week ending July 19th of this year, 51% of people were bullish on the stock market. That was pretty close to the high of the year in stocks. So in general, this helps give us an idea of, where short-term prices might go, at least to feel good that, some of the selling that's already out there might be in. So what tends to happen after years in which an asset class loses money? And I've shown this before, but I think it's very important to remind people that 94% of things you could have invested in last year lost money. That is abnormally high. 105 out of 112 asset classes lost money in 2022. So the idea here is really that, what tends to happen in years in which the stock market and bond market or lots of things go down, whether it was 2008, 94% of things went down. But then again, you have these next couple of years abnormally better than people project. So I wonder, what the next couple of years might look like. Well, maybe bonds tend to do better than people think from here, and stocks could too. So I think the idea that the odds of losing money from here, based on what happened in 2022 and to some degree what's happened so far this year, are less and less. So hang in there, stay in your allocation, and make sure you're rebalancing and investing when you can. The next chart I want to show you is just the S&P 500 cycle composite for 2023. Ned Davis does a really good job on this, and what they do is this blue line here is what they think the stock market would do this year based on a 1-year seasonal cycle, so how the market performs every year, a 4-year presidential cycle, it's the third term of a president, and the 10-year decennial cycle, just taking every 10 years of the market and looking back for every year that ends in 3. And if you do that going back to 1928, they give you some seasonality ideas of how markets might perform. And the orange dotted line is what the S&P 500 has actually done so far this year. And you can see that it's not perfect, but the trend is kind of there, kind of peaking out around that July, mid-July, early August kind of time frame. And there's definitely been a correction in bonds and stocks since mid-July. But for many investors, we're still up on the year. And if we kind of take a look at how the end of the year might finish based on history, is you usually get some rallies in November and December, the Santa Claus rally, etc. So I am confident that, from a seasonality cycle, from a sentiment, from earnings hanging in there, there are some reasons to be optimistic in stocks, moving forward. And as we're in this third term of a president cycle, and we're going into a presidential election year next year. So at this point, what I'd like to say here is just that the U.S. stock performance, has the first half of a presidential election year tends to be a little bit on the low end of performance for stocks. The first 6 months tend to see about, just a shade under 3% return. Not terrible, but on the low end of the 6-month periods of various terms of a president's cycle. And then you'll see that the last 6 months tend to be pretty strong in a presidential election year. So, as we talk about what's happened in 2023 and try to keep an eye, obviously, on 2024, the idea here is that, to still stay the course, because once you do get a president, you get some finality in Washington, there tends to be some optimism around what they might do to spur, economic growth, ensure there's less job losses, etc., and advance towards the future. So I want to thank everyone for attending. And if you have any further questions, feel free to reach out to me directly. Thanks, and have a great day.